For that, Hormuz, so interesting list as always. By the way, advanced decline is now clear 2:1, 2 down for every 1 up. And the Nifty's got about 30 odd points in terms of gains. Shiv Sehgal is with us, President and Head of Nuvama Capital Markets. Shiv, good to speak with you. It's been a while. Thanks for joining in. So what's been keeping you busy, Shiv? What pockets of the market and just give us a sense of what you've been doing.
Hi, Prashant. Always good to see you guys. Hi, Rima as well. I think it's important to understand, in the context of what's happened in India over the last 18, 24 months. The Indian market was completely out of favor for several factors. A lot of that has been discussed in your show as well. The key important ingredient there is this, none of which originated within the domestic economy, right? We've had, lots of discussions about the FPIs pulling out the maximum amount of dollars out of India in the last couple of months, and chasing the AI hardware trade in the rest of the region. And then, of course, we have had the Iran war-driven energy shock, which has amplified the correction in the overall stock market. But if you look at even last year, we were discussing, post-Trump, the US-India trade deal had been kind of stalled and exports were getting hit. So there's been a multitude of factors which led us to this energy shock that transpired a couple of months back. And that's why foreigners have pulled out 31 billion this calendar year, which actually is the maximum India has ever seen in any calendar year. And we have, this is only for the first half. What I would like to tell everyone is that, if you look at in the last 24 months, September 24, India's, MSCI India share in EM was almost 21-22%. And that's dropped down to almost, below 11%. And of course, we've all talked about the fact that, the INR USD has been the worst performing currency. That's the story we all know, right? What I would like to, bring to the fore here is that Indian markets, yes, been flat for 2 years. Last time they were flat was in 2018 and 19. However, there are some differences between then and now. Predominantly, this time around, metals and PSU banks led the rally. They've been the best performing sectors, up 15-20%, while we have had the traditional defensive FMCG and IT. You were just speaking about that, leading the downside, down 12 and 20% respectively. This time around, however, if you see, both mid caps and small caps have performed better than the Nifty, suggesting that the cyclical weakness is not an issue at the moment, right? And I want to tell everyone here in your audience as well that the oil headwinds, which amounted to a temporary drag on growth, are not a structural impediment, right? And if you look at what India has done, and hats off to what has transpired in the last few months, the government has diversified crude sourcing to almost 40 countries, right? For instance, India has become the largest oil importer from Venezuela in May. We have entered into new term contracts with Brazil, US, West Africa to reduce dependence on any single corridor. And the rest of the world has done the same, right? So the reliance on the Hormuz Strait has become lower and lower, which is great. The point I'm trying to make, I think the second half of this year, you're going to see inflation expectations ease. And as that happens, the inflation surprises, that central bankers anchor expectations of cuts are going to materialize in real rates. And as a result of which, I think global liquidity is going to be a lot more in the second half. And as a result of which leads to the crux of the matter, is that I think the dollar is peaked, and that's going to be very beneficial to emerging market countries and currencies, and India is going to be a big beneficiary.
Yeah, I was no, that macro backdrop is useful, but it's also well understood, right, Shiv? I mean, it's not new. So I was hoping you'd dive straight into when I asked you what are you doing, you dive straight into kind of themes and thematics and sectors and subsectors, because look, who knows, right? I mean, who thought this entire Hormuz thing will happen? We were expecting all of it in the first half. Now something may happen tomorrow. We don't know, right? So you got to work with whatever is thrown your way. So in that sense, what are you focused on?
So I think, just to your point, Prashant, I think that's, yes, anything can happen geopolitically. But I think if you look at what oil is doing and, markets look at prices, I think it's very clear that the market is no longer worried about the US-Iran conflict. The markets are showing that, yes, you might see some little bit more volatility, but just from a price perspective, and market is adjusted to that volatility as well. Coming to India and the sectors, I think yes, last quarter earnings, the war was, literally 4 weeks into it. This time around, I think yes, there will be volume drag, there will be margin compression in some particular sectors as they report earnings for July. But I think it needs to be audience needs to be aware that the market has already factored that in, and we are going to look at, how it's going to transpire over the next 2 or 3 quarters. And from that perspective, if you look at, Nifty at 18.3 December 2027 forward earnings, it's almost at a 5% discount to your, 15-year average multiple already, right? So the forward multiple of roughly 17 times on FY27 estimates is actually the lowest since the COVID-19 pandemic. The valuation compression that has happened at the index level, and that is going to coincide with the earnings recovery that is just about to happen. That's a combination that historically has defined good entry points. So we are very cognizant that, if you look at certain sectors, as you rightly said, so I think there's a large dispersion that's happened. And I'll give you some examples. Like if you look at industrials, they're trading at a premium to IT on a 1-year forward sales basis, which is unprecedented, right? Private banks today are cheaper than metals on a price to book basis. FMCG dividend yield is now higher than that of power sector. So there are, opportunities that are presenting, and I think the market will start looking at that, given the macro backdrop. And I think I have turned extremely bullish in the second half of this year, with the thesis that the dollar has peaked and the liquidity is going to become a lot more available, not only for credit growth and the RBI deposit raise, what they've done for NRIs is a masterstroke. If you look at any of the estimates floating around, India is going to get about anywhere between 70 to 100 billion dollars, and I think that's going to flow back into the economy from the bank's perspective, and NBFCs and banks and insurance companies. You were talking about that earlier as well. I think all these elements are going to come in play, and we are quite positive on that. So I think cyclicals and AI proxies, which is industrials, metals, and power, we have seen a leg up there. I think that rotation will happen, and the defenses like private banks, IT, consumer, which look cheap, are going to see a lot more rotation into the second half of this year.
Will India attract flows in the second half of the year if, assuming Kospi, Taiwan continue to deliver on earnings expectations as they have up until now? In that scenario, say for the next 12 months, will global liquidity find its way to India?
Rima, great question. I think, one thing to be aware of is that the market is already factored in and a lot of allocation has happened. Portfolio managers, global asset allocators have already made money and the momentum trade has happened, right? Now we can call it whether it's a bubble and things are going to correct. As we speak, Korea is already down 18-20%. SK Hynix is now talking about an ADR listing, and all that stuff will happen. Everyone, if there is a fad, there's a momentum. They're going to try and bask in the sun when the sunshine is there. Coming to India, it's important to realize that global asset allocators, especially emerging market data that you look at, right? As we speak today, they're running a 50 basis points underweight position in India, right? And which is a sharp reversal to the 10-year average of emerging market hedge funds. If you look at their allocation in India, right, that was about 2.2 to 2.5%. Even a small shift there, given where valuations today are, where liquidity today is, I think it will see a monumental shift. And that in the last 10, 15 days is starting to happen in institutional desks, where, for the first time, I'm seeing foreigners come back and ask us, ideation. They're asking us, where do you think we can actually deploy money? Till about 3 months back, 4 months back, that was not even a question. All that money was flowing into Korea and Taiwan. I think that rotation is bound to happen. Also because there is a little bit of euphoria that is placing in the AI and the semiconductor space as well, right? The rally in semiconductor stocks is not being supported by the hyperscalers. In fact, if you look at the US and some of the region, the hyperscaler stocks are down about 15% in the last 1 or 2 months. And chip shortages could result in capex moderation, which I think will derail this thesis. And that's the reason I'm quite bullish in India in the second half.
Shiv, we leave the conversation here, out of time. We've got less than 30 minutes to go to wrap up today's trading session. Thank you very much for joining in.